Next sum, we are moving to the 42 sum. The creditor of the shareholders have been agreed up to a scheme of a reconsideration of a A company. So the A company going to be a reconsideration went into a voluntary liquidate. Themselves they voluntarily they want to reconstruct. The balance sheet of the date have given of the understood. So there's a not they never given any date, but this balance sheet was A Limited, that is a old company. Now we are moving to the schemes. What schemes they have converted, reconstruct? A new company or called a new company. That is old company is called as a Limited, but new company is called as a new limited, to be formulated and share capital of a 50,000 of a shares into 10. The 50,000 shares into 10, that is called as a 5 lakh. To take over the from above of the company, from the old company, that's A company, they have taken over from the A new company. Stock and debentures 20% lesser. See, for A company, we have to take this values, but for new company, we have to take a different values. It's given from the adjustment. So less the booker value. So from the stock value, they are given as a 50,000. From the 20% lesser value, we have to take for the new company. Similar, building and machinery also they are given a new value. Next one, B. The shareholders agree to receive 25,000 of a equity share rupees 10. That's only we have given in the liability side, but the creditor with the 5 per. So 25,000 into 5 to find out our purchase consideration. Next one, the debenture holders were satisfied by issuing a 6. In balance sheet, it was a 5. When they are receiving as a new company, it was converted as a 6% of a marginary. So debenture percentage will be similar. The value will be changed. Next one, new company exchanging into a old company. That's old company, it was 1 lakh, but new company it's taking as a 1,50,000. Creditor agreed to receive a 35,000 for the new company. So old company it was a 40,000, new company it was a 35,000. The next one, the bank balance was utilized the payment of reconsideration expense. The cash at a bank 2,000. It was utilized for the reconciliation expenditure. We have to mention in a journal. So given a journal entry for the old company and new company. So we have to mention the selling company journal and the purchase company journal. Int. New company take over the debentures and creditors as then settled. So they have taken it the debentures and the creditor as themselves as a settled. Now we will move on to the answer of this thing. So calculate the purchase consideration equity share. They have given it. What they have given it 25,000 into 10, but it 5 is the credit. So we have taken 25,000 into 5. The value is a 1,25,000. That is our purchase consideration. 25,000 it can be paid by the equity share of a 2,50,000, but purchase consideration is called a value is a 1,25,000. Next step, we are moving to the realization of the old company, that is A company. Again I am repeating, realization account means asset will go by the debit, liability will go by the credit side. So again in debit side, if you are getting a balancing figure, that is a profit. If you are getting in a credit side as a balancing figure, that is a loss. So asset all the value is going to be mentioned. Machinery 95,000. Building 95,000, machinery 1,50,000, 1,05,000, stock 50,000, debentures 60,000, cash at a bank 2,000. Now we are moving to the liability side. 5% debentures 1 lakh, creditor 40,000, purchase consideration 25,000 into 5, 1,25,000. So if you add here, it's a 3,12,000, but here is a difference, so automatically realization is loss 47,000. Now we are moving to the selling company journal. The first selling company journals means we have to do the asset journal, then we have to move on to liability. So asset realization account, the total realization account is a 3,12,000 and the asset value we want to mention. Business building 95,000, machinery 1,05,000, stock 50,000, debentures 60,000, cash at a bank 2,000. Now liability side is a 5% debentures, 1 lakh creditor 40,000. If you add both the things, you will get it as a realization account 1 lakh 40,000. Next, purchase. Which new company we have purchased it? So purchase received account, a new company limited, account debtor to realization 1,25,000, 1,25,000. Next, we are going to receive it. So that is a price of purchasing. Now receiving. Shares in a new limited 1,25,000 to the A new limited 1,25,000. Now we are going to do the expenses value in question. The last, the E they have given, the bank balance was utilized as a reconsideration of expenditures. So here a new company of how we have taken in a question bank cash at the bank, that cash at the bank value we are taking it. New company limited debtor to the bank 2,000. Reimbursement, why? Because they are reconstruction, so that is meaning as a reimbursement. A bank account debtor to a new company 2,000. Next we are moving to the debentures holder account debtor to debentures account debtor to debentures holder account 1 lakh. Next one, the payment of the debentures holder account debtor to debentures 1 lakh of a new company. Next we are moving to the equity share. Equity shares are given in a balance sheet. Equity share capital account debtor to equity share holder 25,000 into 10, 2,50,000. Next we going to mention profit and loss of the balance sheet, but in a old limited we got it as a loss from the realization account. So for that reason only I have mentioned here for transferring the loss. So old company balance sheet profit and loss we are mentioning. So equity shareholder account debtor to profit and loss account 78,000. Next one, realization loss we found it from the realization account. Equity shareholder account debtor to realization account 47,000. Last one, the payment. The final payment will be the equity shareholder account debtor to a new company 1,25,000. Till this old company journal was completed. Now we are moving to the new company journal entries. When we are moving to the new company journal entry means in purchase journal we have to write. But here all the values we have to take it from the new adjustments given in the schedule of reconstruction. Okay. So here first one is purchasing. Business purchase account debtor to liquidation of a limited 1,25,000. 1,25,000 is getting from the purchase consideration. Next, journal entry asset and liability. Here we have a few adjustments. Stock in the balance sheet they have given a 50,000, but in adjustment they told minus 20% of less than. So 50,000 minus 50,000 into, wait, I will calculate in front of you, 50,000 into 20%, you will get it as a 10,000. So from the 50,000 minus 10,000 you will get it as a 40,000. Similar debtors also, so they have given as a 60,000 into 20%, the answer will be 12,000. From 60,000 minus 12,000 you will get it as a 48,000. Next, building they are given a new value 77,000. Similar, machinery also they are given a new value 1 lakh. Next, till now we have found it out what are the assets we have mentioned it. Now we are moving to the liability side. debentures. In adjustment, they are given their old company take over it. So the new company has a 1,50,000. Creditor also it's mentioned in a question 35,000. Purchase, business purchasing is a 1,25,000. Now the asset value and deduct from the liability value, the goodwill value you will get, that is 45,000. Now we are moving the payment of the purchase consideration. So liquidation account debtor to the share capital is a 1,25,000, 1,25,000. Similarly, we have a expenditure that cash at bank is converted into a expenditure. So cash at bank account debtor to bank account 20,000, 2,000, 2,000. Last one, we are going to settle our debentures. So here debentures account of a new company 1,50,000, creditor 35,000. Similarly, so debentures account 1,50,000 to which creditor we are converting into a bank. So 35,000. This is the 44 sum answer.